It's a calm Tuesday morning, early March, 2026. A woman named Sarah sits at her kitchen table, coffee in hand, scrolling through her bank app. She's done everything right for over a decade. Same job, consistent savings, no reckless debt, emergency fund intact. Financially responsible by every traditional standard. But then she notices something that makes her stop. $30,000 sitting in her savings account, earning 0.01% interest. She does the math. That's $3 a year. $3 on 11 years of discipline. She puts her phone down, and for the first time, a simple thought crosses her mind. There has to be something better than this. And in that moment, something shifts. Not in the economy, not in the banking system, but in awareness. Because what Sarah is experiencing right now isn't a personal problem, it's a systemic one. And at this exact moment, she is not alone. Across the United States, trillions of dollars are quietly moving out of traditional bank accounts. No panic, no breaking news, no lines outside branches, no alarms. Everything looks completely normal on the surface. But underneath, something very real is happening. This is what many are calling the silent bank run. And unlike the bank runs you've seen in movies or history books, this one doesn't look like chaos. It looks like calm. To understand why this matters, you need to rethink one basic assumption. Most people believe their money sits safely inside a bank, waiting for them, stored, protected, untouched. But that's not how the system works. When you deposit money into a bank, that money is immediately put to work. It's lent out to homeowners, businesses, corporations, developers. Your savings don't sit still, they move. They become mortgages. They become business loans. They become the foundation of economic activity. Banks are not vaults, they are engines. And like any engine, they rely on fuel. That fuel is deposits. Cheap deposits. And right now, that fuel is slowly disappearing. Over the past few years, something subtle but powerful has been happening. People haven't been rushing into risky investments. They haven't been chasing hype. Instead, they've been doing something much simpler. They've been moving their money into money market funds. Now, on the surface, that might not sound significant. But the scale tells a different story. As of early 2026, over $8.2 trillion is sitting inside money market funds in the United States. To put that into perspective, that's one of the largest pools of liquid capital in financial history. And it didn't happen overnight. In just 1 year, nearly $1 trillion has flowed into these funds. Week after week, billions continue to move. Even in a single day, tens of billions can shift direction when uncertainty rises. This is not random. This is not emotional. This is math. Traditional bank accounts are offering near zero returns. In many cases, as low as 0.01%. Meanwhile, money market funds are offering around 4%. Treasury-backed instruments are not far behind. That difference may seem small at first glance, but over time, it becomes enormous. And when millions of people start noticing that difference, behavior changes. People like Sarah are not panicking. They're calculating. But this kind of shift isn't new. If you go back to the 1970s, you'll find a very similar pattern. At that time, banks were restricted in how much interest they could offer depositors. At the same time, inflation was rising and market rates were increasing. So savers were stuck earning less, while better opportunities existed elsewhere. Eventually, money market funds were introduced. They offered market-driven returns, liquidity, and accessibility. At first, they were ignored, even dismissed. But the numbers were undeniable. Money moved. Billions of dollars flowed out of traditional banking into these new instruments. And eventually, the system had to adapt. Now fast forward to today. We are seeing the same story, but at a much larger scale. And this time, there's one major difference: speed. Technology has removed every friction point. Moving money no longer takes days. It doesn't require paperwork. It doesn't require a visit to a branch. It takes minutes. That's why this shift is accelerating faster than anything we've seen before. Out of the $8.2 trillion currently in money market funds, nearly $5 trillion belongs to institutions, pension funds, corporations, asset managers. These are not emotional investors. They don't react late, they move early, based on data, models, and risk assessment. And they've already moved. Now retail investors are catching up. Individuals are starting to notice the gap. And once they see it, the decision becomes straightforward. So what happens when banks start losing deposits? They don't just absorb it quietly. They replace that funding but at a higher cost. Instead of relying on low-cost deposits, they turn to more expensive sources. Borrowing from other institutions. Paying higher interest rates. This reduces their profitability. And when profitability shrinks, lending tightens. Fewer loans get approved. Requirements become stricter. Access to credit becomes more limited. This is where it starts to affect everyday life. Buying a home becomes harder. Mortgage approvals drop. Interest rates feel heavier. Small businesses struggle to secure funding. Expansion plans get delayed. Hiring slows down. The economy doesn't crash. It slows, quietly, gradually. And most people don't notice until it directly impacts them. We've already seen how quickly things can escalate. In 2023, several major banks collapsed within days. Not weeks, not months. Days. Depositors didn't stand in lines. They didn't panic publicly. They simply moved money digitally. Billions were withdrawn in hours. That moment revealed something critical. Bank runs no longer look like panic. They look like silence. And now, there's another layer adding pressure to the system. Global uncertainty. Whenever geopolitical tension rises, investors shift toward safety. And right now, that safety often means short-term, liquid assets like money market funds and treasury-backed instruments. This pattern is not new. We've seen it during oil shocks, financial crises, and periods of instability. When energy prices rise sharply, the impact spreads everywhere. Transportation becomes more expensive. Production costs increase. Food prices rise. Inflation follows. Consumer spending slows. Economic growth weakens. And this affects everyone. Your daily expenses increase. Your financial flexibility decreases. Opportunities become more limited. Even your savings are affected not because they disappear, but because they grow too slowly compared to what's possible elsewhere. Over time, that gap compounds. And compounding works both ways. It can build wealth, or it can quietly reduce what your money could have become. But it's important to stay grounded here. Not all financial options are the same. Bank deposits come with certain protections. Money market funds operate differently. They are generally considered low risk, especially those invested in government securities, but they are not risk-free. There have been rare moments where even these funds experienced stress. That doesn't mean avoid them. It means understand them, because the people moving billions of dollars right now are not acting blindly. They are managing risk carefully. They are maintaining liquidity, diversifying across institutions, staying flexible, monitoring conditions closely. These are not dramatic moves. They are disciplined adjustments. And that brings us back to Sarah. Because Sarah represents something much bigger. She represents millions of people who followed the traditional path. Save consistently. Avoid risk. Trust the system. And for a long time, that worked. But the system has quietly evolved. The rules haven't been officially rewritten. There's been no announcement. But the environment has changed. And continuing to operate with outdated assumptions comes at a cost. Not immediately. Not dramatically, but gradually. The goal here is not to create fear, it's to create awareness. Because once you understand what's happening, everything starts to look different. You start asking better questions. Where is my money actually sitting? What is it earning? What could it be earning? What risks am I taking? And what risks am I ignoring? And that's where real control begins. The silent bank run is not about banks collapsing tomorrow. It's about money moving today, quietly, consistently, logically, driven by simple decisions made by millions of individuals and institutions, and the only real question is, are you aware of it? Because the next phase of this story is already unfolding. What happens next depends on interest rates, global conditions, and how financial institutions respond to ongoing pressure. It could stabilize, or it could accelerate further. But one thing is certain, the people who understand what's happening early are the ones who stay in control. If you found this valuable, share it with someone who should understand this shift. And if you want the next breakdown where we go deeper into what actions actually make sense in this kind of environment, make sure you're subscribed.